Good morning and welcome to the Killik & Co market update. This morning we've had the publication of the latest retail sales data for the UK, and the data actually contains some really interesting insights about the UK economy. Here's a chart showing the data going all the way back to the year 2000, and what this chart is showing is the annual percentage change in retail sales in comparison to the previous year. The black dashed line in the middle shows you the overall level of retail sales, including fuel. And quite unsurprisingly, there has been a drop in retail sales in 2020 in comparison to 2019. In fact, it's a 1.9% drop. But what's perhaps more interesting are the coloured lines, and these show the various components that actually make up retail sales. So the pink line is our spending in food stores. That rose during 2020. The green line is our spending on clothes. As you can see, that experienced quite a significant fall in the year 2020. But perhaps the most interesting is the spending in non-store or the internet category. And as you can see, that's been trending steadily higher over the last few years. But in 2020, it experienced quite a significant spike. In fact, it was over 30% higher in 2020 in comparison to 2019. Now, we know that online spending has been a big trend of lockdown, but it's just really helpful to have some data that shows this trend so clearly. And we also know that there have been lots of beneficiaries of this move to more online spending. Clearly the online retailers themselves, but also companies like digital or online payment companies, cardboard box companies, delivery companies. Lots of different companies have benefited from this trend. So we're going to be watching closely to see what happens when the lockdown restrictions start to be lifted. But we do expect that many people will have tried online shopping for the first time during lockdown, and that many people will stick with it to some extent. On Wednesday this week, Joe Biden was sworn in as President of the United States, and markets reacted very positively, although some of this market rally could have been due to relief that the ceremony went smoothly without any violence or protests from Trump supporters. Biden has made it very clear that one of his key priorities as president is going to be tackling climate change, and one of his first acts as president was to sign an executive order re-signing the US to the Paris Agreement. In fact, Donald Trump took the US out of the agreement back in 2016. The Paris Agreement is a legally binding treaty that requires countries to commit to reducing their greenhouse gas emissions. Doing this will require the US to move away from fossil fuels towards renewable power. So over the course of this week, we have seen strength in the share prices of some of these renewable power names over in the US. Next Era is an example. Here's the share price chart over the last year, and you can see there has been a notable rise over the course of this month so far. Please do give us a call if you'd like to hear more about our thoughts on investing in renewable power. And finally this week, we wanted to highlight some of the strong results coming out of the US banking sector recently. There's still a wariness around the banking sector following the financial crisis, and also the banking sector performed particularly poorly when the pandemic started because people were worried that banks would sustain losses due to individuals defaulting on their mortgage payments or even companies going under and not being able to pay back company loans. However, banks have performed far better than expected. A number of the big investment banks in the US have done well, partly because markets have been volatile and their trading divisions have done very well, and also because IPOs and acquisitions have still been going ahead, so banks have made substantial fees from that. There's also been a large amount of government support, which has helped to support individuals and also companies, so loan losses have not been as high as banks expected. In fact, at the start of the pandemic, most of the big US banks set aside huge amounts of money to cover potential loan losses, and it's looking likely that they won't need a lot of that money. To put this into context, here's a chart showing JP Morgan's share price over the last year. You can see the share price fell quite heavily at the start of the pandemic. It remained weak throughout the summer, but more recently, the share price has recovered almost back to where it was before the pandemic started. And we've also had very strong results from Goldman Sachs this week, which beat expectations. Moving on to have a look at next week, we're looking ahead to results from some of the big tech companies, Microsoft, Visa and Facebook. That's it from us. Enjoy the weekend, and we'll see you next Friday.